Okay, we are going to take a look at a young super producer in this video. And what I mean when I say young super producer is an individual in his early 30s that does very well, has done very well for the past 7 years, is in sales. We actually work with him. He helps our company, has really helped our company grow over the past 2 to 3 years, and I bounce a lot of ideas off of him. But this individual, he was 33 years old when he reached out, specifically about a cash value life insurance policy. And I remember the day I was at home. It was raining pretty heavy that day. My brother had crashed his car. He was okay. So a lot of stuff was going on. That's probably why I remember this so well. Is I get an email from, his name's Steve. So Steve and Steve, he emails me, he goes, "Hey, Steve, can you tell me a little bit more about the product that you sell, the whole life insurance, the high cash value product? I've looked at it before. I'm not really into the whole pay until I'm age 65. That's not me, but I've seen enough stuff where I'm intrigued. Can you tell me more about it?" I'm like, "Yeah, I'd be honored to do so. You've helped our company grow so much." He is an influencer at his company as well. And just in the industry, he works with a lot of companies. So aside from just a personal policy, there are other potential opportunities there as well. I try and refer him business. You never know what happens just as you network and work with individuals. But he is 33 years old. He reached out. He wanted more information. Now, he had been pitched on cash value life insurance before, which we're going to get into. So what I want to kind of set the parameters with first is his overall goal. So if you're in a similar position to this, when we see and hear people that have done very well, this individual's income, Steve's income, at age 33 was about $500,000 per year, $500,000 to $550,000, no debt, has over $1 million invested in other assets, doing very well for his age, and he's just getting going when you look at his overall picture. Now, he does have his goals laid out. Next level, that's one of his goals. How do I get to that next level? So thinking big. He is really starting to move. He's at the millionaire status, him and his wife-to-be. He's engaged. I think he's still engaged as of today, but I'm not quite sure. So if he's watching this, don't hold me to it. But getting to that next level, specifically, what does that mean? Well, mid-40s, he has a goal to hit a net worth of $25 million. That is his goal for between him and his fiance, his wife-to-be. Right now, he donates money. He likes to spend time with his wife. They actually make it a point to drive to work together. So she'll drop him off, then he'll come back home. She'll pick him up. This way they have time just to talk, make sure they're doing everything together, and consistently communicate, which is extremely important. My wife and I actually reset our goals a couple months ago, 2 or 3 months ago, where we made it a point to get up at the same time together at 6 a.m., work out, and then do a couple of things on our own together. And we've been able to spend more time, which I've thoroughly enjoyed. She has thoroughly enjoyed. But it's very important when you've got that satisfaction, you're happier, everything else tends to be much more productive as well. That is something I always believe. You got to be positive and happy. If we're down and drained all the time, we're not going to be productive. So he spends time with his wife, donates money. He's into that, and he's doing very well. But again, from a financial standpoint, how do I get to that next level and just break through? That's always the question. How do we do it? Because we see people do it. What are they doing? So right now, what he's doing with his money to get to that next level, he invests in personal development, investing in himself. And this can be through his constant role play and communication with other individuals in his company, going to events, learning from others. I invest a ton here as well. Very, very important. So important. In fact, I'll tell you a big distinction that I'll see between top entrepreneurs, sales professionals, and then the average everyone else is the top people invest in this. How do they get to that next level? And if we don't have money to invest, we live in a time where information is abundant. We can find it online, on Google, on YouTube, and personal development can involve practicing a presentation. Maybe it's a pitch, maybe we're trying to communicate how cash value life insurance works. It can be a complex product to sell. This is something personally on the personal development that I practiced so many times over and over and over again because I knew it, I just couldn't get it out of my mouth. This individual in his profession is extremely sharp. Real estate. He invests a lot in real estate right now into real estate syndication deals. However, he does a lot of research, self-education on real estate. This way he can begin to invest in his own personal real estate that he owns and controls 100%. This is a goal of his to learn more about that in order to hit this $25 million net worth. Now, the liquidity, liquid cash other than a bank account. Because if we put money in a bank account, what does it do for us right now? It's liquid. I can get to it right away and use it for anything I need. As a business owner, there's definitely value there. I agree on that point. But what's the drawback? It's like putting money under a mattress right now. It doesn't really earn much for me at all. So where can I put my money that is still safe, not tied to, not invested in the market? He's not into that one bit, but is still liquid. Cash value life insurance. This is where he reached out. He had seen some of our content. He's helped us with personal development and business coaching. So when we first started our YouTube channel videos we were putting together, I would send it to him, not this was unintentional, not to pitch him to purchase a policy. That wasn't the intent at all, but I wanted to get his honest feedback because he works at a company that when it comes to marketing, YouTube production, education is top in the industry. So I've got access to a resource here to say, okay, how do I get information from him or how do I mimic what they do as fast as possible? So I've got a resource, send him the info. What are your thoughts? He'd give several recommendations. We would make adjustments, but at the same time, he's learning about it. And this is what prompted him to reach out. So the first thing he said in his email to me on that rainy Saturday afternoon, or was it Sunday on a weekend? My brother crashed his car. He was okay, my brother. He was pitched on it before. Not into the age 65 funding. He stated that up front. So when it comes to cash value life insurance, a lot of times we hear, hey, it's a whole life insurance policy. You have to pay premiums for your whole life, or it makes sense to pay a high premium as long as possible. If someone comes up front and says, I don't want to do that, am I going to force the issue? Absolutely not. And the thing is, with a cash value life insurance policy, you're going to see this as we get into it, where we can design it for maximum cash value, which addresses the liquidity question he had. But two, we can fund it for a short period of time, but if he wants to continue to pay money into it, guess what? He can continue to shovel cash into it. So when we first connected, this individual earns about $500,000 per year. He's looking at $20,000 to $25,000 initially because he's not that comfortable with it, right? He's got to learn it. He's got to understand. So yeah, he wants to look at some samples, $20,000 to $25,000. I'll let you know, he did that, $100,000 per year. So why would he do that? I'll let you know it's not because I sold him on that. I'm not some fantastic salesman. I'd actually say I'm a horrible salesman in a lot of ways. But why would he move up to the $100,000 option? He had to see the value. And this is an individual that wants to see everything transparent, upfront. The details must be there. And it's important to me as well because I've got a strong relationship with him that long-term can work out to be very beneficial for both of us. So it's more important that I be transparent because if I do some knucklehead move and I'm not transparent with him, what could happen? Hey, Steve, Parisi, why did you not show me this? This would have been valuable for me to know up front. Come on, man. That's where you start to break those relationships. We don't like that kind of stuff. So what got him? Here's the question. Why would he pay in $100,000 per year? Well, when I look at a whole life insurance policy with cash value being the goal, the death benefit, not important to him when he opened this policy. It's becoming more important now as he's going to be married soon, may have kids in the future. It's good to have. But when he purchased it, he's like, hey, the life insurance, I don't really need it right now. Yeah, long term, it's great, but I'm interested in the cash value, Steve. Teach me about that. So, core benefits to a whole life insurance policy. If I do everything properly, it is a safe, liquid, tax-free area to position money. Big if on the tax-free piece, make sure we don't trigger a MAC, cash it out with a gain on it. We've got other content on that. So we went through those core benefits thoroughly. If you haven't seen our videos on core benefits of a whole life insurance policy, I'd encourage you to view those. Same thing with the tax benefits. The liquidity, he was interested in. Loan feature. So a unique feature to a cash value life insurance policy is that once a dollar passes through the cash value of a policy, regardless if I just let that dollar sit and grow, say it earns 4, 5%, whatever it's earning, I can let it sit and grow, or I can loan, I can borrow against it, and I will continue to earn that 4 to 5% as if I never touched it in the first place. Just like if he has an appreciating piece of real estate, if it's appreciating at, let's call it 5% every single year, and he borrows against it, he takes a line of credit or mortgage out against that property, if the fair market value goes up by 4 or 5%, it goes up by 4 or 5%. It doesn't matter if I have a mortgage outstanding or not. Same thing with the cash value life insurance policy. He resonated with that. Okay, so with the loan feature, we wanted to show it, which we did. What did it look like when he pays money into the product, then borrows, pays it back, doesn't pay it back, pays the interest only? Show the different scenarios, best case and worst case scenario. But then here's what really was intriguing, and this is also what's intriguing and one of the most attractive aspects to me, the flexibility. I want the ability to pay $100,000 per year into a safe, liquid, tax-free area to position my money. I do not want to get a bill for that. I'm not into that. So how do I make it flexible where if I want to add more money, I can, but I'm not committed to it? Policy design. This is the most important piece, which made it a point to go through very thorough with him. If you've worked with us, we make it a point to go through this very thoroughly. We've got a lot of video content, but our agents do a fantastic job as well. Where can my money go in a life insurance policy? Two main areas. I can pay money toward the premium. So let's be specific here. He ended up paying in $10,000 per year. Total in premium was just over $10,000, and that is a combination of his base premium, also his term insurance rider we attached. So he can pay money towards the premium or toward the PUA rider. Now, if you're new to this, because the term PUA is an insurance term, it stands for paid up additions. It's a form of dumping money straight into the cash value. We see it available immediately, begins to compound sooner, does purchase me some additional life insurance as well, paid up additional life insurance. That's why we've got that term there. But what many individuals do when they're interested in cash value is ask the question, how do I put as much money as I possibly can into this PUA component? And that's always the question. Often, as low as we can go with a lot of the top companies being the 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, we have this 10/90 split, which is exactly how it was constructed. So if I have a premium of 10%, how he came into this is he wants the ability to pay in $100,000 per year. So we set that premium at $10,000. In the first year, guess how much shows up in cash value of that premium, that $10,000 portion? Zero. Couple $100, not quite zero, but it's next to nothing. Not enough to see any real value there. Beginning year 2, that premium piece does come back to cash value. But in year 1, behind the curve, nothing shows up. The reason why? Purchasing me a death benefit immediately. $90,000 shows up in cash value. Just about all of it. There are PUA fees, which we mainly see impact us in the first year. They exist in all years, but usually by the time we hit year 2, we see the compounding of the policy overtake the PUA fees. And when we look at our net cash value, that's what we always focus on. That factors in all insurance expenses, fees, all that good stuff. So this optimizes the cash value. So what we want to know is how do we lower this, commit to this only. This way, I make $500,000 per year. The $10,000 minimum payment is not that much of a burden at all. But if things go very well, if I find myself with additional cash that I'm not throwing into real estate, investing into personal development, I want more liquidity there, I can plow money into here. The thing is, this is optional. Going back to the flexibility piece, I can throw it in there if I want to, but I am not billed for it each year. Very flexible. Now, as we went through the different options, he made a comment saying, hey, I like the idea of funding it with $500,000 and that's it. So $500K for 5 years and just having a big pile of cash value grow over time. I like the guarantees. The guarantees, he broke even right at year 5 as well, just about year 5, based on a worst case scenario assumption. So let's look at some numbers here to see exactly what we progressed through on what he did. So what we've got, young, super producer, $100,000 per year, is where is the money going? So the first thing I always like to show, whether we lead with this or show it at some point in time, is what does the policy look like if I plan big? I'm going to pay $100,000 per year into it and then I don't do it. I only pay the minimum amount because that is what I'm billed each year. What will it look like? Well, here we see minimum fund for 5 years. So here's a policy where he can pay $100,000 per year, but he's only paying the minimum. 100% base premium, stops paying it early. Look at that. Year 1, he pays in 10-2, $335. Year 2, he pays in $10,000. He gets most of that back. He's at $9,500 in cash value, so he has some equity there. But what happens? I mean, year 5, I've paid in $51,000 and I've got $34,000 to show for it. That's an expensive life insurance at that point in time if I look at it that way, $3.5 million. Then we drop the DB because we didn't overfund it. We could drop it year 6 without it mecking. But still, when do we actually see it break even? 16 years. Who wants to do that? Not an attractive area to position his money. This is something I like to show to people we work with. What does it look like if I have a policy that's very flexible, but I'm not overfunding it? Important to see this, unless someone says like, no, I'm not going to do that. I'm going to max fund it every year. But it is good to build awareness in this situation because this is a case where buyer's remorse can come up. Remember, if I'm engaging with him, he's not in the industry. I cannot expect him to know this without me communicating it. Frankly, I can't expect him to know it after I communicate it 1 time, 10 times. If I'm in a different industry, it's not fair to expect someone to understand it just like you do. Some people do that are very sharp, much smarter and sharper than I am, and we like working with them, but we like working with everyone. Let me get back on track. So, minimum fund. Now, here's a policy. Same exact policy. Minimum premium, $10,200. This death benefit of $3.5 million, where that came from, going back to policy design, what has a direct relationship to our MEC limit. If you haven't seen our content on the MEC limit, what that is a taxable line on a life insurance policy. Why so many people are attracted to cash value life insurance is that if you do everything right, that cash value has tremendous tax benefits. I fund it with after-tax dollars and I can access the money tax-free. If a policy becomes classified as a modified endowment contract, this MEC, which any life insurance policy can become classified as this, the cash value still grows tax deferred, but anything I access, I have to pay ordinary income tax on the gains and a potential 10% penalty tax. It ruins everything. I don't want it. My point here is every policy has a MEC limit. The beauty of it is we can set that MEC limit wherever we want. How we came up with this $3.5 million death benefit when someone says, I don't care about the life insurance, we're solving for the minimum death benefit needed in order to pay in $100,000 per year. That's where we came up with that figure. $3.5 million for a 33-year-old male gives him a $100,000 MEC limit. So here, same minimum premium, but he's paying in just about another $40,000. That reads additional PUA contribution. So a total of $50,000 per year for 5 years. So his goal with the policy specifically was to do what? Max fund it at $500K, which we do show. We're going to get to that next. But what if he doesn't do that? What if he only pays in $250,000? What is the impact of that? Just about year 5, he's paid in $250,000. He's got $249,000, just about breaking even. So does perform quite well with a 50% fund. Funding 50% of the MEC limit. This technically would be about a 20-80 split when you look at it. Meaning if I'm paying in $50K, 20%, about $10,000 of that $50,000 is going toward the base premium, the rest into PUAs. Now, let's look at the good one here. So, max fund, $100K for 5 years. Minimum premium, exactly the same. Only difference with this example is he's deciding at his discretion to throw more money into PUAs. He's in control, can do so through his mobile app, his online portal, can send in a check, very flexible in that respect. Pays in $100,000, cash value, just about $89,000 right off the bat. Same death benefit, $3.5 million. These are all the same policy here. Now continues to fund it, breaking even between years 3 and 4. So by year 4, he's paid in $400,000. He has $404,000, $405,000. Liquidity, money in the bank. Okay, he's looking at this as an alternative to that. Hey, it's not doing anything in the bank. I don't really feel that safe with it there, especially above the FDIC limits. Let me move it into a more secure asset, where it just so happens that banks position a lot of money here. Year 5, he's paid in $500,000. He's got about $518,000, $519,000. Pays nothing in thereafter. Nothing in the premium. Total outlay is 0 indefinitely. He can elect to keep funding if he wants, but he does not, and the cash value keeps on growing. Now, one thing I want to add on here, if you're looking at this and you want the technical aspect, look at the death benefit here on all the examples after year 7. What do you notice? Drops. The reason why is going back to that MEC limit. That's it. Another name for our MEC test, when the IRS has a MEC test on life insurance policies, is what is called our 7-pay test. And really what that means is the first 7 years of a life insurance policy, I'll call it the vice grips, are very tight from the IRS on policies. That death benefit, if we're at $3.5 million and our MEC limit's $100,000, and I pay up to $100,000, and then at any point in time during the first 7 years, if I drop that death benefit, which will reduce my MEC limit, I'll trigger a MEC. 7-pay test, first 7 years. With that said, after the 7th year, we can drop the term rider, we can reduce the insurance expenses. So what we're doing is cutting expenses down to the absolute minimum. I'll refer to this as cutting the drag, because his goal is not to continue to pay into it. If he elects to continue to pay into it, we won't cut the drag, and he can keep feeding it. But now, cash value keeps on growing. All right. So, looks good here. Last thing I like to show is, hey, what if life happens and you max fund it, but then you lose your job, something comes up, and you just can't pay anymore. You don't get disabled, but you cannot make the financial commitment anymore, 0, or a limited amount. We have one example, $100,000 just in the first year, and then the minimum through the 5th year. Breaks even, year 6. $100,000 years 1 and 2, nothing for forever. So $200,000 breaks even year 4. A lot of people like to do this kind of stuff with a lump sum of money. They'll break it up maybe over 2 to 4 years, depending on their age. But they say, hey, I love these benefits of a life insurance policy. Let me plow some funds in. I might still pay the premium, but I don't want to. Can I do it? The answer is yes. If it's got a design like this with a low premium and you're plowing funds into PUAs. And then the same thing here, if we go years 1 through 3, just about broken even year 5, positive from that point forward. So overall, great strategy. He's executing on it and seeing the values build over time. We track the performance as well, and it's going according to plan. So this will help complement his other goals, as now he has liquid cash to take advantage of other opportunities that's not just in the bank account, while he continues to do other things as well. So I do hope that you enjoyed this one. If you have any questions at all, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.